why are they doing this stuff? Like, so sometimes it's like advisors just don't listen to what their clients are telling them. Like, you have a client telling you, I want a simple portfolio. Like, why are you doing all this trade? So part of it is listening and paying attention to what's being said. And part of it is just giving people good advice that allows them to hang in there through the market cycles. It's not AI, it's not language models. It's just like, do commonsensical things, which some people in this financial advisory space don't do.
Welcome to Knowing Me, Knowing You, the podcast for the future of wealth management. Thanks for being here. I'm Marla Sofer. Money is a tool. It empowers people. Let's dive into how technology is personalizing advice, strengthening connections, and creating lasting impact. If you're an advisor looking to differentiate, a fintech leader shaping the next wave, or a client ready to take control of your financial future, you're in the right place. Let's get started. Okay, hello. And today we are privileged to host Dr. Harry Mamaysky, a professor at Columbia Business School and director of the program for financial studies. With a rich background in quantitative finance, Harry's research focuses on the application of quantitative techniques to investing in wealth management. He also serves as a partner at QuantStreet Capital, bringing academic rigor to practical investment solutions. Welcome, Harry, to the Knowing Me, Knowing You podcast. And let me just first say, I know that you have so many credentials that I didn't list off, and please don't be shy to kind of toss them in there. You have just been one of the leading thought voices, professors, academics, practitioners as it relates to quantitative strategies in investing, and I'm delighted to have you here.
Great to be here. Thank you for inviting me to join you.
I'm very happy you're here. What is most exciting to you about where we are right now in wealth management?
That's a great question to lead off our discussion. So I'm kind of new to wealth management. I've been doing, the wealth management side of investing for about 4 years now. Prior to this, I had been an academic at times, and then I worked in industry for a few years, more in the institutional investing realm. So I worked at Morgan Stanley, then I worked at a hedge fund called Old Lane, and then we got acquired by Citigroup, and then it was at Citigroup. And for the majority of that time, I worked in proprietary trading. So we had effectively one client who was the head of the equity division at Citi, and they allocated capital and said, here, go invest. And that was super interesting from an intellectual point of view, because we're trying to figure out how do you take out little inefficiencies in financial markets. But the part of it that was maybe a little bit limiting relative to wealth management is we had one client. I didn't know much about him. I mean, we sort of worked together, and we tried to make money in markets. What's amazing about wealth management as opposed to investment management is we work with people. So we talk to real people, and the real people have real concerns, and they have real needs, and they have, real problems that need solving. And I just find it incredibly rewarding to take the knowledge that I've acquired about financial markets, both in my academic work and in my investing work, and to apply it directly to people, not through a layer of intermediation between me to an institutional allocator who then works with people, but working with people directly. And what's been amazing about that is, as an academic, the academic part of what I do, we study a lot about human behavior. So we look at various psychological traits that people have and various decision-making biases people have. And, there have been voluminous research papers written about this, all really, really interesting. But when you talk to people directly, you just learn in a much more convincing way what drives people, what makes people excited, how people think about their money, how people think about what they use their money for. And I just find that human connection part of it really rewarding. On the what's new now side of things, technology is just transforming investment management as well as wealth management across the board. As a small enterprise like QuantStreet, we're able to offer services and investment vehicles to clients that we would never have been able to offer 20 years ago, 30 years ago, because they weren't available in a low cost, easy to access way. They are now. We have access to amazing data sources amazing analytics, some of which we wrote ourselves, other analytics that we're using off the shelf that allow us as a small enterprise to offer really institutional level solutions to our clients that is made possible by data availability, technological innovations, and new financial products, which we're able to bring together in a way that benefits our clients. And that's really a unique time in history in the wealth management business.
That's awesome. It's a common answer here where I think a lot of people are so excited about access, democratization. More people can access more wealth management products in a more personalized way, have access to data more than ever before. I want to take advantage of the fact that we have leading edge academia, as a guest here on the Knowing Me, Knowing You podcast. You actually have access to so much more of the leading research studies, how to really look at the applicability of this kind of institutional grade quant down into a wealth management portfolio. What is the latest that you can share? Because listeners of this podcast are generally people in the wealth industry, fintech people, and also individuals. And so I think they're curious about, what do we not have access to? What is still kind of in the halls of Columbia that we don't know and we should be knowing, because we want to make our work as a wealth industry much stronger and better for our clients?
Okay, that's a great question that has many different answers, but let me give you one answer. So everyone has been reading about the impact that AI models, and in particular large language models, have had on the investment landscape. On the research frontier are things like ingesting all of the news flow that's coming out across all countries, all geographies, all companies, everything, feeding it into your large language model to process that information, to distill from that information what are the really interesting new tidbits of knowledge that we didn't have before, that frankly are inaccessible to any one human being, because no one person or even no team of 10 or 20 people can read all of that news flow. So if you process all the news flow in real time and you see what's that emerging piece of knowledge, that emerging phenomenon in markets that humans may not be fully aware of, and then you can think about, how do we respond to that in real time? How do markets respond to that in real time? Do they respond to it fully? How should the portfolios be allocated to respond to this information in real time? That's what's happening at the research frontier. And my sense is that that's what's happening with some of the very, very high-tech institutional investors out there, like especially in the hedge fund world. To give you a concrete example of that, like let's say you could monitor every single earnings call that every single company had in the US in the last quarter. So we probably had 3,000 or 4,000 earnings calls. Say you could listen to all of them and ask your data, what are people saying about tariffs? What are people saying will be the impact of tariffs on their suppliers, their vendors, their customers? How is it impacting their business and then the other businesses they work with? And then how is that impacting the entire economy through the linkage of different business connections? So that kind of information would not have been available to anyone in real time ever in the past. And it is available now to those who have the tools and can deploy them in a real time manner. So I don't think that capability is necessarily being used yet in the wealth management space. But over time, it will be. I don't even think that capability is being used in the institutional management space. I think it's at the research frontier, but it's not yet being used in a systematic way. But even taking a step back from that, the question I have in my mind is, to what extent is the wealth management industry using the state-of-the-art financial economics knowledge from 30 years ago? And I would say the answer to that is, it's not fully using that knowledge either.
But what specifically are you referring to?
I mean, like optimal portfolio allocation, right?
Okay.
So these ideas started in academia in the 50s with the work of Harry Mamaysky. And then in the 60s, these ideas led to things like the capital asset pricing model, which allows us to think about the return to risk trade-off in financial markets in its many dimensions of that question. So to what extent is a typical wealth manager, financial advisor working with retail investors, using that knowledge to help people formulate their actual investment portfolios, right? So this is not new knowledge per se. This is stuff we've known about for a while. And the question is, are we using that knowledge to help people optimally invest?
Mm-hmm.
And certainly we are in some cases. I mean, I think there are wonderful investment advisors out there. There are wonderful firms that really are doing great work for their clients. But we've also seen in our work with our own clients and seeing the portfolios that they come to us with from other advisors, that their portfolios are far from that, optimal, efficient portfolio of finance theory, not from 2025, but from like 1965.
Or did they want to? Were they even trying to?
And they were not trying to, and they may not have wanted to, even though this would have served their clients very well. So, my perspective is where the wealth management industry is today, there are a lot of folks out there who aren't getting what we definitively know to be good portfolio investment advice. So even before we speak about how do we implement, the really cutting edge technology, how do we get the large language models in the way that they're helping financial advisors really optimize, their clients' portfolios, let's talk about, to what extent are they using the standard tools of financial economics that we've known about for 60 years, like optimal portfolios in their clients' portfolios today. And, from what I've seen, sometimes they're not using these tools and many times they're not using these tools, and it's bad for their clients. So I think the wealth management industry as a whole, while some people are doing a great job, others aren't. And I think we could do a better job as an industry in serving clients' needs using knowledge that we've had for a long time.
If I was going to restate some of what you're saying in a very different way, what I'm hearing is that number one, there's all these great capabilities. There's access to real-time data. I do have a lot of follow-up questions on like, for what and how, what is that going to look like in the future? But I think going back to what you just shared is so interesting, is like, there has been a lot of research that proves that there is a right way to construct a portfolio to deliver, outcomes that are optimal for a client. We're not even doing that. And to me, what I'm hearing is, some of the reason we might not be doing that is because emotions are so tied up in the money, and people are going to sell what they can sell, and they're going to sell whatever they can sell, and they're going to sell into whatever is going to get them to make a sale. And a lot of times that doesn't necessarily, the measure of success is not how attuned are you to what's been tested and proven many times in academia over the last 30, 40, 50, 60 years. It is, can I address what you need from me on the emotional level right now? And that's what's getting them to make the sales. I wonder if you think about how wealth management can look at the academia and look at quantitative techniques to become more client-centric, care more, not be as swept up in emotional, non-scientific measures and what matters really to kind of help them achieve their outcomes. What would be your advice there?
So that's a great question. And unfortunately, I don't have a great answer. I mean, I think the heart of the matter is the role incentives play in this, financial advice ecosystem, right? So as a wealth advisor, you're incentivized to get clients. And when you talk to clients, I've talked to many clients who come to you and say things like, can you find me, I have a portfolio of stocks and I really think they're going to do really well. And I'm looking to, have 25% returns a year. And I've invested a lot in NVIDIA, and like 80% of my portfolio is in NVIDIA. And like, can you get me 30% returns a year instead of the 25% returns a year I've been making? And, it's for us, it's not a hard conversation for us because it's an easy conversation for me, because I tell them there's no way we can get you 30% returns. It's a complete impossibility. Like the fact that you believe you earn 25% returns on your portfolio is great. I mean, I hope you really did. Every financial piece of advice that you would learn from an academic would be you shouldn't have all your money in 80% in NVIDIA. Like that's too big a concentration. But, you can't argue with success either. Like when the person happens to have bought NVIDIA and it's appreciated so much, or they bought Apple many years ago or Microsoft and it's their entire portfolio, who am I to tell them?
Right. Or Enron. Maybe they were doing great on Enron at some point.
Right. So, that's the problem, is that these things sometimes blow up and sometimes don't do well. And the reason you diversify is because you sort of acknowledge the limitations of your own knowledge to know that NVIDIA will forever go up 20 or 30% a year. It may not at some point. So it's hard to tell a client that I cannot give you what you're asking for. Like you're asking me for 30% returns and there's no way we're going to deliver that. Or you're asking me to look at your portfolio of 30 stocks and tell you which 5 are going to be the winners. I can't tell you that. So we can say that because that's our, heartfelt belief that we're going to tell people the truth. And if we don't get a client, we don't get a client. So be it. But when we talk to people, we're going to tell them what we really believe and what's really good for them. If you're a financial advisor just starting out in the business and a client wants you to tell them, look, I have this great new 3-time levered ETF that if you invest in this and things go exactly perfectly, you'll make 30% return. So they tell the client what they want to hear. The client feels good. Oh, I think this person's going to get me a 30% return, and they invest. So, how do you manage that? I don't know. It's very hard. It's very hard to tell people who need to make money, who have families to support, who need to bring in business, turn away business because you can't deliver what the client is asking you for. So we certainly always do that time and time again, because that's what we believe is the right thing. But other people, they may not have the incentive to do that. And I don't know how you solve that problem. And I think you're right that and by the way, incentives happen at different layers of the system. So if you are an advisor affiliated with a large institution that runs its own mutual funds, but you think Vanguard has a better mutual fund than XYZ firm that you work for, it's very hard for you to put your client half of their money in Vanguard funds when you work at XYZ. Even if XYZ charges your clients 0.5% or 1% more per year in their funds than you can get in a similar fund at Vanguard or BlackRock or some other best-in-class low-cost provider, if you work at XYZ, I'm not naming names, but XYZ, you want to put them into XYZ's mutual funds. That isn't good for your client either. So these incentive problems are very difficult to solve. For us, we solve them. We're independent. We have no incentive to put anyone into anything other than if it's best for our clients. We invest in the same portfolios as our clients. So if it's good for us, we feel it's good for our clients, and we're not beholden to any institution. But the way the industry is structured is people come from large institutions. Those institutions have wealth management business and investment management businesses. And the wealth management businesses are incentivized to invest inside the products of the investment management arm of the company. It's another set of incentives that are difficult to fix in the wealth management system.
Every time I speak with you, it seems like you as a practice at QuantStreet, you've got these stories and they're kind of triage stories. Like you kind of have clients come to you and you see that they've got issues with, as you just explained, with hidden fees and non-transparent incentive-driven models. And then you kind of have to work them through, here's how we're going to kind of triage the situation you're in and make sure that we are using fact-based research to get you to where you should be so that you're on the right track to the future. Are there any stories or anything you can share about here's something that has come across your desk? Every time I speak to you, I kind of feel like, oh gosh, if clients only knew, if they only knew, what was happening. And it seems like there's this level of frustration and just kind of disappointment in like our industry peers in that you're kind of selling stuff that doesn't necessarily meet. And they may not know, frankly. There may be a lot of salespeople out there that are doing what they think is God's work, and it's really important. But at the end of the day, they don't really dive into those incentive layers. So I wonder how that reflects.
Great question. So I think you're right. I do have a lot of that perspective of these triage stories. I can tell you some. The reason it happens, of course, is because the millions of investors who are happy with their financial advisor aren't talking to us because they're already in a good place. So who do we get? I mean, we get people, on occasion people come into a pool of money that is uninvested by anyone. And so maybe we get that as a client. But that's rare. The majority of the time you get a client from someone else and from some other advisor. And the reason you get them is because they're not happy with their advisor. So we never meet clients who come to us and say, I love my advisor. They're wonderful, but I want to work with you instead. Like that never happens. What always happens is like there's something about their advisor that they feel isn't great. Like there's some part of that relationship that isn't working for them as much as they would like it to be working for them. And because of that, they reach out to us. I mean, that's always the story, because with the people who are happy, we just don't hear from them. And I believe there are millions of these people, because we also work for financial advisors, and some of the analytics that you referred to that we have, we sell them as a subscription service to other investment advisors. Some of our investment advisor clients are really intelligent, smart, thoughtful people, and we're not getting clients from folks like them because they are outstanding at what they do. So when we get someone, it's because they're coming from an advisor that they're unhappy with. So that's kind of, I think, part of the story, why that's my perspective, because that's the only type of people we talk to. In terms of stories, we have one client who retired. He and his wife are retired. And in the early years, they're young, in good health, early years of retirement, and fairly conservative. So they don't want to take a lot of risk, and they have enough money to live off of, so they don't need to generate, excessive returns. They just want to be able to sleep at night. And they kind of gave us two little tidbits of information. One is the last time we had a big market sell-off, which was during COVID, they went into it with too much risk. And then when the market had sold off 30% by the early 2020, which turned out to be a temporary sell-off, they felt they had so much risk that they needed to de-risk at that really bad time because the market had already sold off. And then they got rid of some of their stock exposures only to see the market bounce back and basically recoup all of its losses over the next several months. So that's extraordinarily frustrating to people when that happens. And the problem with that sort of scenario is you can't guard against it after the fact, right? That's something that the planning stage of your portfolio should take into account, even if that event happens 5-10 years in the future. So when we talk to clients, one of the first discussions we have, and certainly before we touch a penny of anyone's money to invest, is let's look at the potential drawdown in your portfolio. So how big of a loss are you willing to accept? Like, are you okay if you put $100 with us and at some point in a bad market, that 100 becomes 50? Like, are you okay with a 50% loss in your portfolio? Now, it may be temporary. It probably will be. The market probably bounces back. But at the trough, at that low point of the market, the news flow is going to be terrible. When you turn on CNBC or Bloomberg, all you're going to see are talking heads telling you the world is terrible, things are terrible, because markets don't sell at 50% when there's good news out there. They sell all 50% when everything looks awful. So you're going to be bombarded by stories for why this is the once in the generational sell-off that doesn't come back. The market will be down. Are you at that point going to be okay just sitting there saying, I'm not going to do anything? Or are you going to say, okay, now I'm going to sell and just go to cash at the absolutely worst time? So if 50% isn't okay, which it's not for most people, what is okay? Like, tell me, what are you comfortable with? Like, say you're down 25%. Can you sleep at night? Are you going to be comfortable knowing that it sold at 25%? And if anything, you want to maybe add, not subtract your risk investments. So that's a conversation we have at the very beginning with people. And we won't invest any money at all until we're comfortable with what that risk limit is for that client, what their comfort level. And then when the big sell-offs come, like we had this year with the President Trump trade negotiations with our trading partners, we saw the market sell off close to 20%, about 19% from peak to trough. None of our clients sold, I'm happy to say. All of our clients, they stuck in there. They knew this could happen because we told them these things happen in markets. You should expect it. You should plan for that. And so no one was a seller. In fact, one of our clients added to their portfolios, didn't subtract from their portfolio. But so this is a story of a client who had been probably getting not great advice, went into a big sell-off with too much risk, and then was forced to de-lever, to de-risk their portfolio at an absolutely bad time, and then felt incredibly frustrated as things bounced back. So that's the kind of thing we really try to avoid. Sometimes clients come to you and say, look, I want to have a nice, easy to understand, comprehensible portfolio that makes sense to me, and my advisor is trading like biotech stocks and these small tech companies, and every week they're buying something, selling something. I get my monthly statements. They're like 20 pages long. Like, I can't make sense of anything. Like, why are they doing this stuff? Like, so sometimes it's like advisors just don't listen to what their clients are telling them. Like, you have a client telling you, I want a simple portfolio. Like, why are you doing all this trading? So part of it is listening and paying attention to what's being said. And part of it is just giving people good advice that allows them to hang in there through the market cycles. It's not AI, it's not language models. It's just like, do commonsensical things, which some people in this financial advisory space don't do. Many people do. Maybe most people do. But we see often people coming from the advisors who are not doing that. And then you really ask yourself, like, what's going on? Why are they doing this to their clients? They shouldn't be. So that's the kind of people we end up seeing.
What if financial planning wasn't just about numbers, but about you, your values, your goals, your vision for the future? Nomi is transforming client discovery for wealth managers, going beyond assets and risk scores to uncover what truly matters. With behavioral insights and real-time data, Nomi helps advisors personalize advice, build deeper connections, and grow their businesses. Because the best financial decisions start with knowing you. Discover the future of client engagement at Nomi.com. And then you dig in and you usually find an answer. And that's where you find the incentives generally, I imagine. I think this is it was very helpful. I think that really resonated with me. I'm sure everyone's got a story of, I made an emotional mistake at some point and maybe I even knew better, but I did it. And here we are on the other side of it. And I've got to figure out what to do next. One thing I want to mention, and wanted to give you an opportunity at the end as well, is that you have a fantastic newsletter. And I enjoy reading it. I know how much time and energy goes into it. And I know that you're looking at the markets from the lens of kind of deep academic quantitative expert, and you're making it make sense to other people. It's definitely what I think in terms of like what we're doing with Nomi and why I'm excited about the fact that we've kind of built a relationship and continue to talk to QuantStreet is we're trying to understand how do we use data to share with you what's most relevant and interesting and exciting to help you make better choices. I wonder if you just have like 1 or 2 minutes just on the newsletter and how you go about it. I just think you do a really great job of making the hard simple.
Sure. Thanks for the shout out to our newsletter. So we have a newsletter. Please sign up. You can go to our website, QuantStreetCapital.com, sign up for our newsletter. We have a version of it on Substack. You can hit us up on Substack or on QuantStreetCapital.com. So my philosophy with the newsletter is, first of all, selfishly, it forces me to follow markets really, really closely. Of course, we would do that anyway for our investors because we are investing people's money. But just the fact that you have to put pen to paper and write your thoughts about markets, and I personally have an aversion to looking stupid in front of a large group of people. It makes you really think deeply about what are your own investment beliefs, because it's one thing to think, whatever, I like this stock, I like that asset class. It's another thing to have to write it down on a piece of paper or, electronically and justify your thinking and your logic to other people. And I think imposing that sort of rigor, that structure on your own thinking is very helpful for us to think about our investments for our own clients. But the other thing that I find so rewarding about the newsletter is, yes, we use a lot of very quantitative techniques. We have inside the black box of QuantStreet, we have a lot of data. We have all kinds of data like macroeconomic data, financial prices, interest rate levels. We have data coming from news data sources like measures of economic sentiment, economic policy uncertainty that we get from other folks, but it's available out there. So we sort of take the totality of all this information, we throw it into our forecasting model, and we ask for each asset class, given all this data and given modern forecasting analytics, what does our model think is going to happen to this asset class, both from a return and a risk perspective? How's it correlated with other assets? So we have all this information, but then at the end of the day, the models aren't perfect, are very imperfect, by the way, and they may not know very important pieces of information that are out there in the world that we know about because we read the news. And so the question is, how do you synthesize what your models are telling you with what you're seeing in the world, even though your models aren't observing everything that you're seeing because they have a limited vantage point. They have a limited lens that they can look at the world through because it's only the data you feed them. Mm-hmm. As a human investor, you have a lot more data actually than your model sees. So the question becomes, how do you synthesize all of this stuff? Like what you read in the news, what you believe to be qualitatively true, what the quantitative models are saying? How do you take all of that information, bring it together, explain it to people who are not financial experts or just regular people, regular investors? How do you explain it to them? How much do you pay attention to what you read on, what you hear on CNBC, what you read on the Wall Street Journal, versus what the model is saying, and how do you use all of this information to ultimately make good decisions about how you should position your portfolio? So I think bringing that information to people is very rewarding. We get a lot of feedback from the newsletter, from our readers saying, this is so great, this is so interesting. People sometimes read our newsletter for 2 years and then invest with us. I mean, that's happened on multiple occasions because they learned to trust us. They learned to trust our investment process, our thinking process. It enforces us to use rigorous analysis in our own decision making because you have to explain it to people. It, I think, provides interesting information to our readers. And frankly, it's good PR for our firm because people enjoy the newsletter and it gets our name out there. And we love it when news outlets pick up what we write, which happens from time to time, and say, oh, QuantStreet wrote this and that. That's great. So I think partially it's doing a public service. Partially I enjoy doing it. I enjoy the process. It sharpens our own investing acumen. And I think it's good for the firm. So there's a lot of goods associated with the newsletter. So please sign up.
I think it's great as well. And I also like the tone of it. You do make the information meaningful, but you write it in a tone that is, I'm speaking to somebody smart when I write this. I'm speaking to somebody who can process this type of information, which I also appreciate. Harry, thank you. This has been great. We always end with, what is an instance in your life, something that has happened, a conversation, something that you have gone through, an experience, anything, even an insight that has changed your relationship with money?
Okay, so here's a story that did impact how I think about money, actually. And I kind of forgot about it, but now that you ask. So when I graduated from college as an undergrad, actually I had a master's degree in computer science, and I went to work at the old Citicorp in New York, so like a few miles south of where I'm sitting right now. I started making money. It was like my family, we're an immigrant family. We're from the former Soviet Union, so I never grew up with a lot of money. We were middle class. We had enough for everything. So I never needed, 2 Ferraris. That wasn't how I grew up. And I was working, I was making money, I was saving. And so that was all fine. But then I decided at some point, I want to get a PhD because I really wanted to, become like an academic scholar of finance. So I quit my job that was paying me a decent amount of money. I went, got, very lucky to get into MIT. So I was at MIT and Cambridge, which I loved, by the way. That was a great, great experience for me. And as a PhD student, my tuition was paid for, and I got a stipend to live off of. But that stipend, I don't remember exactly, but it was about like $15,000 a year, like 1.5. And I needed to pay, I had a roommate, but I needed to pay my share of the apartment, and I needed to eat, and you just have to spend some money. And I remember at one point, my advisor, Andrew Lowe, who's a wonderful academic scholar, he was one of my 2 main advisors at MIT. The other one is John Guang, but Andrew was one of the 2. And Andrew invited me and some other students to join him at his health club. So he lived in a suburb of Boston, and someone drove us out there, and we went to this beautiful health club that had these amazing facilities, and we were playing squash on the squash court. And I was thinking to myself, I can't afford any of this stuff. I don't have the money to pay for this health club membership. And it struck me at the time, what's money good for? I never wanted a lavish lifestyle. I don't need to have, 5 houses and a plane taking me back and forth from anywhere. That was never the goal. But I did think to myself, there are some basic necessities of life. I'd like to be able to join a nice health club, just so I can work out, that I don't have the money to do. And that day, that episode in my life, it wasn't a big deal, but just kind of that mental process got me to thinking, the role of money in your life, it's not that money is important in and of itself, but money allows you to do things, healthy things, to be able to lead a healthy lifestyle, to make sure that your family has a healthy lifestyle, that they have access to nutritious food, that they have access to, a health club if they want to work out, that they have access to good medical care, that, those basic necessities that we need in life, money facilitates having them. So, and then I thought to myself, well, that's kind of one of the reasons we work. It's not to become billionaires. It's not to become, not to show off and say, oh, look at my fancy watch, my fancy car, my fancy $800 pair of shoes, which I have a $60 pair of shoes, but it's just to have the basic necessities of life. And, that's the role that money plays. And as someone who works now in the wealth management industry, I feel that is the role I can now play in people's lives. I can help them manage their financial situation in a responsible way that isn't going to make them billionaires. And they don't want to be billionaires. They just want to be able to take a nice vacation, to afford healthcare, to make sure they can pay for their kids or grandkids' college education partially, to just help their families live better. And, I think that 4-year period in my life that I basically had no money, that I had to live off of sometimes credit card debt, and the very low stipend I got just taught me the lesson of the money, the role that money plays as a facilitator of having the basic necessities of life, as opposed to a tool to show off to people how much money you have, which I never think is the right reason to have money. It's just to get the basic necessities, and for yourself and for your family, even more importantly.
to live a wholesome life. I love it. And Harry, thank you. This has been a really great recording. I appreciate all of your profound insights. I appreciate you tapping into your experience as a leading researcher in quantitative strategies, how it applies, if it applies. And I think there's many ways that it's going to continue to evolve in how it applies to wealth management. You definitely bring in, and those who subscribe, and I suggest you do subscribe to the QuantStreet newsletter, you'll see how Harry brings in this unique blend of academic expertise and very practical, down-to-earth ways of making that meaningful in the way that you're thinking about your own personal money, your human relationship with money. And I love at the very beginning that you said wealth was so interesting coming out of institutional and prop trading because it's about humans. It's about human behavior. It's about people at the end of the day. So you have offered a lot of great little tidbits here. If you don't mind, one more time, just share where, again, can listeners find you if they want to learn more?
Sure. If you want to learn more, go to our website. It's QuantStreetCapital.com. Click on the newsletter button. We'll get your email, put you in our newsletter. Reach out to us, send us an email, hello@QuantStreetCapital.com, and we'd love to hear from you.
Fantastic. For our listeners, I hope that you learned a lot, as I always do every time I talk to Harry, in this recording of Knowing Me, Knowing You. And I hope it helps you apply some changes in the way that you are working with your clients or advisors in wealth management relationships. Please share, like, comment, and we'll talk to you next time. Thank you, Harry.
Thank you so much.
Thank you for joining us on the Knowing Me, Knowing You podcast. If you enjoyed this episode, share it with someone who needs to hear it. And don't forget to subscribe, rate, and review. Your support helps us bring more transformative conversations to you. Until next time, keep discovering, keep growing, and remember, you're in control of your own financial story. Follow us for more conversations on financial confidence, self-discovery, and the future of money.